Remember at the end of 2020 when we thought it couldn't get any worse nor unprecedented, ironically 2020's word of the year, and then by the end of 2021 it had? It would be fair to say that 2022 marked the year the hens came home to roost on all the economic and political largesse unleashed in the years prior to fix it. Let's do our annual year in review. Whilst unprecedented was the word du jour for 2020, and irony not lost again in 2021, at least it had to compete with the word transitory for the top billing in 2021 amongst commentators and analysts. The pesky but absolutely transitory US inflation of 2021 finished the year at around 7% from just 1.4% in January 21. The problem was it just plain wasn't, and likely plain isn't, transitory. It peaked at 9.1% in June and is still stubbornly just above 7%. 2022 will be remembered as the year we had the combined tectonic events of Russia invading Ukraine and the events of over a decade of, has to be said, unprecedented loose monetary policy by central banks, printing trillions of dollars and holding interest rates to near zero. What resulted was that aforementioned 40-year high inflation and the biggest, quickest reversal of monetary policy ever. The so-called everything bubble appeared over. The impacts of the Russian invasion on supply chains already broken from the pandemic, and with two of the world's biggest food and energy producers, was and remains massive. We also saw the US government unilaterally weaponize the world's reserve currency, with the inevitable effect of pushing more to move away from using or relying on it. This crystallized the resolve of the BRICS nations, together a massive collective of global population and GDP, to formally move away from the US dollar for key trade agreements. That unprecedented change in US Fed policy also saw the unintended consequence of exporting the US's inflation to the world and putting crippling pressure on emerging and developed economies alike carrying USD and their currencies. It should be no surprise nor coincidence that 2022 also marked a year of huge flows of gold from west to east. Our own Reserve Bank of Australia was both critically late to respond, one of the last central banks to tighten, and then one of the first to lose their nerve and scale back the pace of tightening as it grappled with the impacts of rising rates on our being the unenviable title holder of world's highest private debt holders. To be fair, this was the same RBA that told us rates would be zero well into 2024 and saw us all pile into an already overly inflated property market. Talk about a rug pull. Indeed, central banks featured very heavily in 2022. Whilst the investment mantra was "it's all about the Fed," we saw the ECB shift heavily off their negative interest rates. The Bank of England had to effectively oust an errant "let's throw money at an inflation problem" 3-minute Prime Minister, and as we wrote this week, the Bank of Japan threw a proverbial match on the whole fuel pile with yet to be fully realised consequences. And what did the collective central banks that are overseeing this whole mess quietly do in the background? Buy an all-time record amount of gold. Whilst inflation was the hot topic on everyone's lips, the smarter money were fixated on one nuance that we hadn't seen since the 70s, and that was stagflation, high inflation amid weak growth. As the year progressed, what started as a supposition became reality, and in 2023 we will almost certainly see it in its very worst form, with a full-blown recession, but with inflation stubbornly sticky well above their 2% target. That of course all played pretty heavily on financial markets that became addicted to cheap and plentiful liquidity for over a decade. Literally nothing was spared outside of the USD and precious metals. 2022 marked the year of the biggest losses in bonds and the foolproof 60-40 portfolio ever. The following provides a summary of what that all looked like up to December 22nd this year. Our trademark is balance your wealth in an unbalanced world, and we preach asset diversification in the truest sense of the word in terms of uncorrelated assets. The table above clearly illustrates how normally uncorrelated assets like shares and bonds can break the mold. Without gold and silver this year, you are likely in the red across your entire portfolio. And remember, that is before the almost consensus call on a global recession next year. Let's remind ourselves too of where the world's largest share market index, the S&P 500, sits now compared to 2008. Finally, we want to say a huge thank you to all of our new and existing customers for your business this year. It was great to see everyone in more normal times, without masks or onerous rules, to see your smiling faces and the camaraderie we share with so many. We particularly thank all those customers supporting the new office in Melbourne and your recommendation of Ainslie to your friends and family. On behalf of all the team at Ainslie, we wish you and yours a wonderful Christmas and holiday season. Hope you stay safe and healthy, and look forward to seeing you all in the new year. Thanks for watching. Please like, share and subscribe, and balance your wealth at ainsliebullion.com.au.